And so in the theme of no filter needed, what's your social security number? I'm kidding. Don't answer that. Don't answer that.
The best opportunities are the opportunities that aren't obvious to anyone. But that is what it is, bullshit in, bullshit out. Then maybe you're a great investor, but you're not a great fund manager. They did not see eye to eye with me on this, and yet I pursued it. So when I hear people talking about scaling venture, it's like, what the fuck are you talking about? Venture is not scalable. The number doesn't matter. The valuation doesn't matter. The sexy company doesn't matter. What matters is...
Superclusters is where we demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Welcome back, Superclusters fans, and today we have someone who I've been meaning to have on the podcast for a very long time. In fact, since the beginning, season 1. Asher Siddiqui. Asher is the LP whisperer, my words and a bunch of his friends' words, but not his. I'm not sure if he'll ever accept that title. He is an active investor in emerging fund managers and a GP coach to help emerging managers institutionalize. Asher is a very special person to me. He was the first LP I'd ever met, and the person who fueled me with the activation energy to write the Emerging LP blog post, which ended up going a little bit viral. Prior to being an active asset allocator, he was a venture investor since 2016, including at 500 Global, Sukna Ventures, and more. He has incubated a number of venture firms, including the likes of Race Capital, Footprint Coalition, and yes, that is Robert Downey Jr.'s fund. Abu Dhabi Financial Group, just to name a few. Prior to venture, Asher became the youngest vice president at Etisalat and eventually their global head of M&A. And throughout this episode, you'll hear exactly why and how he got there. There is way more to Asher than meets the eye, as he's also an entrepreneur, an operator, a researcher on emerging managers, a wine connoisseur, a foodie, and someone who's got a whole lot of stories you've never heard of. This conversation knows no bounds, and we talk about how Asher helped launch CNBC Africa, why trusting the process matters as the global head of M&A at Etisalat, and how it relates to discipline and fund managers today, exit strategy discipline, and what is the telltale sign to long-term success as a GP. Without further ado, Asher, thanks for joining us.
Hey, I'm so excited to be on the show. I've enjoyed watching it, listening to it, and so excited to be here.
This podcast, to start things off, and our frequent flyers also know this, has a track record of starting from, let's say, atypical places. And so one of the interesting nuggets that I've come across when I've been lucky to put the hours in the metaphoric research gym, and I don't know if this is good enough of a lead-in, so you let me know if this is good enough of a lead-in. But specifically, I'd love to talk about your aversion to a statement. The sky's the limit. Which you once mentioned and started since you were 8 years old. Let me know if I'm directionally accurate there.
Yeah.
How come?
I used to be obsessed with clouds. And funnily enough, I'm still obsessed with clouds. If you go to my Instagram, you'll find more clouds or pictures of clouds and videos of clouds than anything else. And part of this is because I was traveling a lot when I was a little boy. We used to be on a plane all the time. And every time I fell asleep, my siblings would tell me, "Oh, did you miss that cloud? That cloud was amazing." And so anyway, this long obsession, and I'm a bit of a thinker. I guess I was a little bit of a thinker, daydreamer, when I was a little boy. And I just started looking at the clouds and then looking beyond the clouds and looking up and thinking, wow, I guess I had heard this term, the sky's the limit. And I guess when I was 8, I had this epiphany. It was like, the sky's not the limit. We're above the clouds. And then it just keeps going. And I don't know, I just started to feel sad when I heard people say that, say the sky's the limit, thinking, oh, how sad that they think that there is a limit, because, I just don't see it. I don't know. It's just childish, childlike. I don't know if I answered your question there, but yeah.
At some point, does it veer into, so Carl Sagan, who's a phenomenal astronomer, astrophysicist, has this saying. I hope I'm not butchering his words, but he has this thing where he says, "We are all star stuff," and there is an element of that where he kind of effectively says, "We're on this tiny blue marble in this vast ocean of just like darkness and stars and all these other things and nebulae gases and all." I'm curious, when you start thinking about, okay, there is no technical limit, when you hear the saying, and these are my words, not your words, but when you hear the saying, "We are all star stuff," are you awestruck by you can literally do anything in this world and it like there are no repercussions? Or are you like, oh, anything I do is so infinitesimally small that may not be worth doing?
Well, so maybe a hybrid of those two is kind of like the way I view the world, which is like my belief system actually is so closely aligned to what you just quoted, which is, we are insignificant, pieces of stardust. But that doesn't mean our lives aren't meaningful. So I accept that I am insignificant in, as time goes. But I'm not gonna wallow in despair because of it. I'm going to make it as meaningful and as interesting as possible. So I guess the point that I'm making is, I didn't dictate when my parents met or whatever they did, and I can't dictate or determine when I die or the manner of it, but I can sort of, drive what that journey looks like.
I want to fast forward a little bit to your time before being a capital allocator of any kind. Here's a lead-in. CNBC Africa. You were a member of the, I don't even know what this means, to be completely honest, which is why I'm asking this. You were a member of the pre-launch development team at CNBC Africa, a brand I'm sure many of our listeners are very familiar with. What does the early scaffolding look like when you're about to launch a pan-continent news channel?
So first of all, I don't want to take any credit away from the team that actually launched. I had left a year before the channel was actually launched, but that was an interesting experience. That was actually a fascinating experience. I mean, I got lucky, some nepotism. So the two co-founders of CNBC Africa were Zafar Siddiqui, and if you haven't guessed already, similar surname, and yes, he was my uncle, and Rakesh Wahi, who was actually a mentor and coach of mine, and the two of them started this firm and started this project, and I was just lucky. I was kind of like at a loose end at the time, and they were like, help us build a business plan for this. That was an interesting journey because it helped me to appreciate how little I knew about how much work is required and how long it takes and how difficult it is to build a business that, generates these pixels that people are consuming. And I didn't really appreciate any of that. And I didn't really even understand how they made money. So I guess what was interesting and valuable for me was being part of the process of building that business plan. You have to deal with an entire infrastructure of regulations, policies, channel partners, distribution partners in order to get on there. So it's not enough for you to produce content. You have to navigate all of that. While we're doing all of this, creating enough of a narrative and enough of a progress in the development to be able to attract investors and convincing them that the market is ready and the viewer base is there and we can actually get there and we'll be allowed to do that. And now that's complex for one country. Now imagine you multiply that with dozens of countries. So like, a whole continent, that was challenging. And my takeaway was this did not happen because, of one, two, or three or whatever. It happened because the founders were visionary and they were just resilient. I mean, there were multiple times when I was there when we were, the project was almost abandoned. And they kept at it, and they, 1 year after I left, they had launched, and can you imagine what that means? And they did it from Dubai. Like we were in Dubai and we launched in Joburg, and like part of the reason why I left was because I didn't want to move to Joburg, but that's another story. But yeah.
How did your uncle and Rakesh have the wherewithal? Because, as you mentioned, there are tons of obstacles, tons of roadblocks. The existing players don't want you around. They don't care if you're like multi-global, like just a global brand. What kept them going?
What kept them going and what made it real was the fact that they were two different people and very two different types of personalities. Um, they complemented each other. So Rakesh was very much a numbers guy. He was very much an execution machine. And, my uncle, Siddiqui also had, a lot of these, execution capabilities, but his superpower on a relative basis was the ability to sell a story, to this narrative, to be able to build relationships and networks and sort of blow things up and, it's like create a reality out of a dream. They believed before anyone else believed that the African market was ready. And they stayed the course. It was their dogged belief that they were right and the market just didn't know it. The investors just didn't know it. And they needed to prove it to the rest of the world. And I think that is the one thing. And I know this is not a business thing, but I think their fundamental belief that they were right and they needed to prove the rest of the world that they were right was actually the only reason why that happened, because like everything was against them.
What belief, what like first principle thinking did they have that led them to believe that Africa was ready for such a news channel?
Yeah, so I mean, and that's kind of like, I guess I'll cover sort of the basics, the obvious, right? The African market, there was a perception, from the outside that the African market is a development market. It's a market where you go to help. But they had actually been in and out of Africa. They've been to different markets. They've been exploring. They had an inkling. They had a hypothesis, and then they went and they explored that hypothesis. And the more they went and they traveled to different parts of the continent, they found that there was economic activity. They could clearly see the signs of economic development. They could see the growth in GDP and in GDP per capita. They could see that stability. And development, political stability and development in the levels of sophistication in the political apparatus led to, development and of the business environment, which meant that there was more foreign capital coming in, but also local capital, and local money was to be made. So they started to see all of that, and they saw that there was this disconnect. There was so much resistance from a lot of the African based news operators. I mean, partly it was just like a knee-jerk reaction, like, we don't want competition, but also because the established local regional players knew that the market was ready and they wanted to be there to dominate, and they didn't want competition. And so they were, the resistance to them was even fiercer. So I guess what I'm trying to say is that ultimately, look, they were analysts and businessmen, and they could smell the money. They could smell the opportunity, but they also knew that the best opportunities are the opportunities that aren't obvious to anyone. And since then, by the way, they own their holding entity that owns not just Forbes, CNBC, but it also owns Forbes Africa, and so they have a full stack. They were also early to realize that it wasn't just television, terrestrial or satellite, but also they looked at mobile, and so they have multi-layered sort of. They had a digital news segment, so they thought about the whole stack. And they built, a business that includes CNBC Africa and Forbes Africa, and actually educational establishments and universities like Lancaster University in Ghana.
If we could take a step back, actually, one thing you mentioned was that Rakesh was like an executioner, analytical guy, executioner. You had Zafar, your uncle, who was like the visionary, the dreamer, the storyteller. oftentimes for these partnerships, we might see a similar dynamic. There is one person who's super analytical, an executioner, boots on the ground, and the other who's just like a great storyteller. But the big question I often have in my head is these are two, in many ways, competing personalities. If shit hits the fan, like it is a very easy recipe to disagree and drama will ensue and all that. And so I'm curious for you and your experience, at least between your uncle Zafar as well as Rakesh, how did they make it work? What were the dynamics that allowed for two very different personalities to work with each other?
When they started the whole process, they were already sort of, mature, like they were established. They had careers. So I guess they managed that, but also they appreciated each other's abilities. And I think that what they appreciated was that, these people had built teams. So my uncle was a partner at KPMG before he decided to, switch from auditor to media. And he had built teams. And what he realized was that he couldn't do anything on his own. He needed to build a team to do it. And Rakesh similarly had done the same thing. Rakesh was in the armed forces and he had, built teams and worked on execution. And they both appreciated that execution is nothing without a vision, and a vision is nothing without execution. And I think they both appreciated that. So, just a spin out of that is, and I haven't, to be honest, I haven't thought about CNBC Africa for a long time because I was such a small, tiny piece of it. And really it was more to do with nepotism than anything else. But, I had been a daydreamer. My mother wanted to kill me, probably daily, if not weekly, because she used to say, like, if only there was an Olympic, sport called daydreaming, then Asher would be a gold medalist every time because of, her frustration with my
You'd be the
lack
Michael
of,
Phelps.
Yes. I just could not get my homework done or whatever. But at the same time, what I realized was I was this big, massive dreamer, but it was working with Rakesh and my uncle was when I realized that you actually had to get things done. And look, I had been an entrepreneur and I had got stuff done and I was sort of like a bit of an execution machine. But what I saw with them was that you actually have to do both.
Is it a daily practice you have where you're bouncing between execution and does this compare to the vision? And tactically, what does that look like?
I mean, my life is a little bit chaotic right now. So I think what it looks like today is very different to what it looked like before. And I guess also I'm further along in my career. So I guess I don't have the same daily pressure. So, I mean, let's maybe refine that question if I may,
Go for it.
or if we may, which segment are we talking? Are we talking about Asher today, or are we talking about, Asher, in entrepreneur mode, or Asher in corp dev mode, or venture mode?
Why don't we start with Asher then? And how did you balance execution and vision at that chapter of your life, which circa, what is this, like 2007, 2008?
If we just look at the financial model. So, initially, so I was an analyst and just for context, I joined, at Tislat, which is now called E&, Group, and they're, they were at the time, the largest, listed, company in the Middle East, not just, telecom group, in one of the largest telecom groups in the world. They had, they were based in the UAE, and in the UAE, the UAE was being opened up for competition. So, deregulation of the market. And so, as typically would be done, they hired McKinsey. McKinsey came and, gave them, the obvious sort of suggestions, which is, you need to diversify and you need to sort of expand. So, you need to diversify your revenue source of revenue. And so, the logical thing is you need to cut costs and hunker down because you're already a highly penetrated market. And you need to, become more efficient at dealing with competition. But at the same time, you need to expand into other markets, and growth markets because you're a low growth, sort of environment. I mean, what's interesting is that is like that's not exactly the case, and that's not exactly what happened, because the UAE, doubled and tripled its population in that time frame, and so instead of being a stagnant, low growth market, it was actually a high growth market. As part of that whole process, what the board decided to do is create a new company called Etisalat International. And the primary function of this company was to invest and acquire in other markets and invest in, new markets. So that was, we were sort of incubated like a startup within a large corporation. So that was kind of me. So my first couple of weeks in, I was thrown in, and I was an analyst, and I honestly did not know anything about mergers and acquisitions or corporate finance. So they basically gave me a bunch of documents to read, and the documents that I was told to read were these McKinsey documents that were the board presentations that they'd made to the board, which were basically the strategy, the international strategy. And that was kind of like setting the baseline for me, the benchmark for me in terms of, okay, contextually, this is what we're trying to achieve. So, once I understood that, then you go into the micro. And so every time I looked at a deal, I'm like, well, is this, I came up with a framework for a checkbox, right? So like a checklist, which was, is this something that meets the criteria? Does this deal meet the criteria that that is going to help us achieve our objectives? Is it in a growth market? Is it a market that we understand? Is it a developed market? What is the profile that we're looking for? And does that fit within our strategy framework? And it was a broad framework. And then, and you could keep going, right? So that's just at the selection level. But then when you go all the way down to the business plan level and building the business plan for, say, an operator in a local market that we're about to launch, if we buy the license, if we choose to buy the license, then, what does that look like? And, the obvious high level stuff is, okay, the board wants growth. Therefore, let's just come up with certain parameters, and then let's just set the growth benchmarks for growth, and then let's just have a high-level top-down model, and that will drive how the business plan will do, and therefore how the telecom operator will do. But the reality is, that's not how the world works. So what I would do is I would go deeper into the assumptions, and I would say, well, guys, I appreciate that we're making these assumptions and that they align with the long-term strategy and the long-term goals of the macro goals of what we're trying to achieve. But these numbers make no sense whatsoever. We're assuming an ARPU, an average revenue per user of X, and yet the disposable income or the GDP per capita is Y, so therefore that doesn't work. And if we're assuming GDP growth of this, then so I guess what I'm getting into the weeds here, but what I'm saying is when you get into the assumptions, you're like, well, those things don't work, so it doesn't make sense. So let's just recalibrate those. But then at the same time, if you go too much into the details of those, then you're over-engineering the assumptions of a business plan, because the reality is, the best case scenario is we will be able to somewhat accurately predict what will happen in the next 12 to 18 months. And the further down you go, the less accurate our predictions are. So there's this like interesting balancing act that you have to have where you constantly have to, go into the woods and then step out of the woods and, be able to see between the woods and the trees. And you have to keep going back and forth, up and down, like sticking your head out of the sand, looking around. What are the assumptions? Does this make any sense whatsoever? Going back down. And it's sort of an iterative process. I remember I almost got fired I didn't get fired, but I remember my bosses and the investment committee looking at me thinking, have we made a mistake here? When I try to explain to the management team is that, valuation is not a science. It is a sequence of decisions that you make that compound into a work of art that we wrap up into Excel and present it as science. And I know that sounds overly, complex, but that is what it is, bullshit in, bullshit out. And so the point that I'm making is that people used to take valuation as science, like this is the answer. And what I would try to explain to them is like, we don't know the answer. All that we can do is run the process as well as we can, do the work that we can, where we can get to as many data points and use as much logic as we can, but also, head out, go to the macro and make sure that this is directionally sensible and logical and makes sense. And then somehow you're sort of like creating this model that approximates what the value of this may be. And you will never really truly know what the value of everything is. Like everything in nature has an intrinsic value. You will never know that intrinsic value. All you can do is model, and the better you run the process, the more closer you may be to being in the ballpark of that intrinsic value. And if you do that well enough and you run the process. So I guess what I'm trying to say is that what was less relevant was the number. What was more important was the process. That was something that I understood when I was in M&A.
Yeah.
But what was interesting was today when I work with LPs, or when I work as an LP with GPs, what I realize is that what I learned in M&A is true today and is as true in venture as it is in M&A, because, like the number doesn't matter. The valuation doesn't matter. The sexy company doesn't matter. What matters is, are you running the right process? Are you running the process the way you're supposed to be running? Now, obviously, a lot of those things matter as well. I'm not saying they don't matter, but the thing is, it's like, we're getting ahead of ourselves, and I apologize if I'm screwing up the train of thought here, but
we meander, so that's okay.
Yeah. So what I'm saying is that, of course, it matters that you have access, that you have unique insight, that you have this view, the world view, and that you have access to the best talent, and that you can sort of identify them and get access to them when it's hard to get access to them. But when you're a venture firm, you're not a one-trick pony investing in one company. You are a steward of capital. And you're a steward of talent, and you're a steward of founders that are building things that are going to change the world. That is what you are. And when you are that, you are not an investor. You are a platform. And that platform's role and function is to manage capital on behalf of LPs and deploy that capital into opportunities that are going to provide outsized returns. And you have to do it repeatedly. And if you do it repeatedly well, then you will build confidence with institutional LPs that will say, this is where I want to allocate capital, because I'm not writing you a check once. I am building a relationship with you, and I want to build a relationship with this manager because this manager is building an institutional platform that is going to repeatedly do what they do. And they will get it wrong sometimes, and they will get it right sometimes. And just because you had a 20x outcome in your first fund does not mean that your fund 2 is going to have repeat allocation from your LPs. Because if you got a 20x, and this sounds amazing, right? Like a 20x outcome in your fund 1, but your fund 1 didn't provided great financial returns, but it cannot demonstrate a process or a pattern where all of your outliers fit into, then that just means that you were the equivalent of somebody who went to Vegas, knew which crap tables where the right time was, or knew which slot machines were at the point where enough shills had gone and pumped that this is the timing. That's going to Vegas. That is not why people give you money.
Right. I'm curious for you.
Sorry,
and you can...
we've got ahead a bit, but
No, this is good. This is good. You've kind of like done the lead in for me. You've done the homework for me in terms of leading into this. Do you have any examples, whether during your time at working in M&A? I should also caveat that for those, if I didn't mention the intro already, like for those that were still curious of Asher's life as someone in M&A, you were the youngest vice president of Etisalat at the time and eventually became the global head of M&A for a massive business. And so I just want to call that out because, Asher, I know you're freaking humble, and so you're never going to say that yourself, so I will say that for you. So just to put some context behind for all this for our listeners. That said, do you have any examples, whether during your time as running M&A at Etisalat or with GPs, where like that is a process that is repeatable and it's not just going to the slot machines at Vegas? Because right now, at least from what I'm hearing, this all makes a lot of sense philosophically, theoretically, but just to make it more, concrete for our listeners, do you have any examples of that?
We invested in a minority stake in Indonesia with a view to build up ownership and then become a controlling shareholder investor in a telecom operator in Indonesia. And what we realized was that that path wasn't going to, we weren't going to be able to find a pathway towards that because the strategy of one of the other shareholders had changed. And initially, when we had come in and become a minority investor, the telecom group out of Malaysia, Telekom Malaysia, had this view that they wanted to divest their international assets and focus more on their local market. And so we invested with that understanding and coordination with them. And what happened is in that process, their shareholders decided, no, actually, they should have a global expansion strategy. So they rebranded into Axiata Group, and then that led them to sort of doubling down into their international companies. There was nothing wrong with that, it was just that we were now a 20% shareholder in a minority in a listed telecom operator, a number 3 telecom operator in Indonesia. And this is not strategic. We're not a financial investor. We're a strategic investor. We're a telecom operator. Our day job is to run, build, operate telecom networks, not invest in companies as passive shareholders. And so what I did was, the challenging part is to run a strategy, recognize that the strategy didn't work. Now you could do 2 things. You could shut up and forget about it and nobody will know because there's so much going on. Or you say, actually, I'm going to go up to the board or the management team and the board and say, this thing that we think is cool, but maybe we should exit because it's a distraction. And because we had this strategy and the strategy didn't work out. And, sometimes strategies don't work out, but we can actually make money. And so now before I get to that point where I decided, okay, this is the strategy that we should do, before I went to the board to say, hey, the strategy is not working, I also did my homework because I wanted to make sure that whether we could get out and whether we could make money and this would look good, because obviously you need to have a full package. And so what I started doing was, and this is going to sound a little bit odd, but as a telecom M&A guy, I started doing research, that was not sort of the typical M&A research. I started looking at, so this is 2000, it was after the financial crisis. So, 2010, 11. So 2010, 11, 12, I started looking at the local Indonesian market, the economy, and figured out what was driving it. And what was driving, it was a listed entity. So it was what's driving the stock market? What's the economy? Trying to understand, again, refresh myself on the understanding of, the Indonesian economy. And when I did that, I started to see that the equities market had actually, gone up like gangbusters since the financial crisis. And so then I started looking at why that was. And I found that, in the financial crisis, there was a flight to safety and risk off strategy. So what happened is there was all these funds that flowed from established developed economies like Europe and US and markets there into emerging markets that were somewhat insulated from the financial crisis. And the reason why by the way, they were insulated was because in 1997, they'd had their Asian financial crisis and they'd actually done some reforms. And the reason why I was aware of the financial crisis was because I was an entrepreneur working with suppliers in the Asian financial crisis. So it was kind of an interesting sort of, rabbit hole that led to some sort of interesting epiphanies into my own experiences. But so getting back to what I was seeing was I realized that, these markets were somewhat inflated. The question was, how were the established markets doing? So by 2011, 12, you started to see that Europe and US markets were getting their act together and things were starting to, quantitative easing had an impact and things were starting to sort of stabilize. And so there was only a matter of time before investor confidence was renewed in established markets. And so the worry that I had, or the opportunity that I saw, was that these capital flows would flow back to established markets. And so then what I thought was, maybe this is a point in time that will never be seen again in the Indonesian stock market. So what I pitched was, not only is this not working on a strategic level, we are, in my view, overvalued, and we believe that there will be a macroeconomic sort of events that are going to take place that are going to lead to an exodus of capital back to, say, safety or lower risk appetite, and so that will lead to an opportunity for us. So, long story short, this was like a tough battle up all the way, because it was hard to sell that, and it took me sort of 18 months to get it done, but we did get it done, and we sold at, interesting enough, this is like 2012, we sold at an all-time high. So we invested, so just to understand, we invested $400 million to acquire 20% stake. When we sold, that stake was worth almost $800 million. So we 2x our money in 3 or 4 years. I know that doesn't sound too cool for venture, but in M&A, that's a hard thing to do. So and what's interesting is that since then to today, the share price has not recovered to those levels. So we did sell an all-time high, which is why I'm sort of very proud of it. And the reason why it was one of the most interesting deals was because it was not obvious. And you had to look in the non-obvious places to learn about what was going on in other places, to learn what was going to impact you. So I guess what I'm trying to say is that you have to go down those rabbit holes to discover things. But if you're not having a global bird's eye view picture, then you'll miss things when you're stuck in the weeds. Does that make sense, what I've just said? And I hope that this translates to what we were talking about earlier, which is, to be able to see between the woods and the trees, and going into detail, and then extrapolating up to the 50,000 feet view, and then going back in. You need to go into the rabbit holes to understand how it works. But then those are all nice little interesting, pieces, nuggets that you then need to take up and then see the bigger picture. And that's why, I love what I do. Sorry, lost my trains of thought there.
Such a great example, such a great story as well. You also mentioned that this may not be impressive to venture investors. This is very impressive to venture investors, because let me just put this into like VC terminology, right? This is the equivalent of investing in a company, 18 months after, get to 2x on distributions. And in terms of size per se, like multiple, maybe not like the 10x or the 15x or the 20x kind of thing, but in terms of just like how much time it took you to get to twice your distributions, is very impressive because most of venture investing is what, 10 plus 2 years, but realistically it's like 15 years of a time horizon.
Yeah. I mean, from an IRR perspective, so you're right. I mean, like it's so because of that, it's still in my deal list. So of course I show it,
Of course, you
and
have to show
it's
that.
yeah, DPI baby. So that matters, and it is, and from an IRR perspective, of course. It's fantastic, because in 4 years or sub 4 years, we were able to provide 2x, and also the quantum matters, and
Yeah.
we're talking about $400 million. And that is, that's real money.
That's lots of money. And in the words of something that Chris Duvo said in season 1, episode 1, moolah in the kula.
Moolah in the kula. Yeah. Oh, so by the way, there is one thing that I should say, which is that we didn't necessarily sell everything I wish we had, but we had a hedge strategy. So what we did was, and this I think will sort of resonate a little bit, is that what we did is we sold a majority. So we returned $260 million of profit.
Okay.
And
So
we
like
retained
660 million at that point.
Yeah. And we retained a little bit because we thought that would crash that was already a transaction that we did an accelerated book build, and the market sort of stabilized somewhat, but we then decided to trickle out the rest just in case there were other blips. And so over time we did do well, and that sort of came out, but that was also interesting for me because it was about risk off and lock in your returns, and then just in case there are other upsides, you can dip in. And they were single day, okay, maybe there was an all-time high that we sold at, but there were other peaks in there. And so we sold at, it's called a trickle down strategy. So that's kind of what we employed. And that took about a year or so later. But I mean, I was able to lock in. So anyway, sorry, that was maybe an irrelevant detail, but
no, I think that's a very relevant detail because this is the theme that's been mentioned on the podcast prior, like Yacht Versendorp, right, at Market Link Capital. He talks about exit window diversification, and that it's just as important to dollar cost average your way in as it is to dollar, I guess, profit average your way out. And so that hedges bets. Absolutely. And as investors, as fiduciaries, it's important to be good stewards of capital.
Yeah. And it is so important. And sort of just since you brought that up, and I love that podcast that you did, because that I love so much because, we talk so much and LPs focus so much on access and selection and entry. And, you can be amazing at all of that. And if you screw up the exits, it doesn't fucking matter. You know what I mean? And unfortunately, I have instances that I can't talk about where we did everything right, and then somebody screwed up on the exits, and you miss the timing, and it's like, what the fuck?
It's what differentiates an investor versus a fund manager.
Yes, exactly.
The fund manager thinks very deeply on the exit discipline on top of the entry discipline.
Exactly. And that is why I'm saying it's like institutional grade platforms. That's kind of what I'm focused on. Institutional grade investing by fund managers who are building institutional grade platforms. And that platform is a 10-year platform at a time, 10-year funds at a time. And you need to think about entry and you have to think about exit. And they're just not thinking about it when they're selling, when they're pitching, when they're raising their funds. And they should be. And the smart LPs ask them the questions. And that's when you can tell when people aren't ready.
What are actually, out of curiosity, I mean, I have a set of questions that I ask fund managers that I invest in about how they think about exit strategies. What are the types of questions that you ask, since we're on the topic? What do you ask emerging managers of how they think about exits?
I ask them, so my questions are often trying to understand how they think and what their process is like and what they think about processes. If you ask the baseline questions, which, the obvious questions, you'll get the obvious responses. And then people will sort of like say, okay, cool, they did that, or they answered that question. What I'm trying to figure out is, how do you think about exits, and what's your philosophical approach? And the beautiful thing there is that there is no right answer. And I don't know anything and nobody else knows anything. When I get these perfect responses, that actually makes me wonder whether they know what they're doing or whether they know what they're talking about. But what I'm trying to say is it is a process. And you need to have a view, and the view needs to be your view and needs to be a view that ties into your experiences that have led you to where you are today. Um, and of course you will evolve and learn and, it's not relevant. But the point I'm making is that you have to be thinking about exits, because if you're so laser focused on thinking about building your portfolio and not thinking about exits, then maybe you're a great investor, but you're not a great fund manager.
And if I were to, I don't know if I call it role playing per se, but let's say I give an example, and I would love to hear like what your pushback would be to that. Not a real example, but I'm kind of like playing the idea of like thinking through exit strategy. One of the conversations we had prior in months ago was this conversation about should private market investors be public market investors? And I know you have your viewpoints on that. We won't necessarily get into those viewpoints per se, but let's say I'm a fund manager and I come to you and I go like, hey, my exit strategy is not IPO or M&A, although it is inclusive of that. I think very deeply on VC secondaries, and every time there's a portfolio company that nets that individual company is 3x my portfolio size, or like, my ownership in that is 3x my entire portfolio, I think about selling to like, 1.5x. And my only goal is, as a fund manager, to get to 5x. Anything north of 5x, cherries on top. But the promise I made to my LPs is a 5x on my fund. Is that a sufficient enough answer? And if not, like, what would your pushback or questions be back to me?
What I want to hear is that you're tracking the company, you're tracking how it's doing. You understand very well how it's doing relative to its competitors. You have a reasonable understanding of the competitor landscape. You have a reasonable understanding and a view on the market. You're not necessarily pushing yourself to, and your motivations are to sort of maximize the value from this investment. And you want to maximize the value of this investment. And what's your thought process around that? So what is your thought process? What are you trying to do? And why are you doing it? So in a scenario where you're thinking of taking some off the table, is it because you believe that the market, the sentiment, this is the valuations in this sector are market sentiment driven, or you think that there's headwinds in this market? So you need to have some sort of market view. And if you're going to have a market view, then maybe, but you still believe in the founders, so you may choose to take some off the table. And this is a market risk, not a specific lack of belief in the founder. I cannot tell you what the right answer is. What I can tell you is what I'm interested in backing are fund managers that are in the pursuit of truth, and they're making the best judgment calls in the pursuit of truth that they can at this point in time, based on the decision that the data that they have available. There's no right or wrong answer, because you may get it wrong this time, or you might get it right this time. What matters is, well, this is fund 3, right? But what about fund 6 or fund 7 or fund 8? Are you building a culture for you to be able to continue to build a team that has this culture to continuously follow and pursue the pursuit of truth for the best outcomes based on the process that you have, as opposed to just, shoot from the hip and gut instinct, which is great while you're around. But when you retire and your firm's gone, you've basically created, a culture where people shoot from the hip, and maybe the people that come after you aren't as good as you.
There's a line that I really like that you once told me, and actually it is related to this conversation of market sentiment, which is, and I'm going to read it because it's the exact verbiage in which you use, which is, exiting a position in a company to return DPI to LPs is not a reflection of your stance on the company, but your stance on the market.
Yeah. Well said.
I mean, that's your words,
Whoever
right?
said
Well
that,
said. Mic drop.
I forgot that I'd said it, but it sounds like a smart guy said it. It's too good to be true.
It was you. I don't have you on recording for that, but you told me that, and I was like, that was the time when I was like fiercely scribbling in my notebook, and I was like, oh, that's a good line. I got to write it down. Okay, I want to take a step back here. One thing I did prior to this conversation is I went through all of your Instagram pics. And and I won't like track all of it, but like out of the 290 photos since December 2019, you've
God.
had 62 sunset posts, 2 sunrise ones, 2 stormy ones. Over 1 in 5 posts were just of the sunset and nothing else. And I will caveat with, there will always be clouds in those sunset pics. And if I didn't know any better, I'd say you were a golden hour photographer. All that to say, your most commonly used caption is colon and close parentheses. And so for those listening to this and trying to visualize this in your head, it's a smiley face. Followed by, I don't know if you remember, what do you think your second most used comment was out of all the Instagram posts you've made?
I don't know. I'm at a loss now.
It's okay. I'll tell you.
Yeah, tell me. Yeah.
It is the second most used one is hashtag no filter needed.
Oh, interesting. Yeah. That makes sense. Yes.
And so in the theme of no filter needed, what's your social security number? I'm kidding. I mean, don't answer that. Don't answer that. Regardless, nevertheless, speaking of no filter needed, a lot of asset owners and LPs in general talk about starting their own venture practices. And as someone who has been on the inside and out for multiple years and has spent time incubating firms as well, what do most LPs and investors often get like wrong or underestimate and overestimate about starting their own venture practice?
I think my first question is, why are you getting into venture? Why are you doing what you're doing? What are the fundamental motivations that are driving you towards it? And if it is a momentum-driven excitement, then massive red flag and a word of caution. That's one thing. The other thing is, why do you think you are going to be more successful in getting access to, say, directs or fund managers than, say, the institutional fund of funds that are out there, or the people who are actually professionals in this game? Let's just say you are getting in for the right reasons and you are going to be successful in getting access. Why you? And it's kind of funny that the LPs kind of find it shocking that I'm asking them, because typically that's a question they would ask founders or managers, is like, why you? Well, my question to LPs is, why you and why now? Because what do you have to offer? And the reason why I say this is because some of the best LPs I know are the hardest working LPs, the most focused. They take their job really, really seriously. A friend of mine who is at an endowment pension fund in Sweden. He's one of the hardest working LPs you will meet. They are in amazing tier 1 firms. They have an amazing portfolio. Every time he's going to an AGM for the fund, he will sit down, he will prepare, he will go through all the portfolio companies, he will go through the fund performance, he will go through what's the GPs, the associates, the principals. He'll track them, he'll try to figure out where they've been spending time, and he does a huge amount of detail work. And when I asked him, what is your purpose? What are you looking to achieve from attending that AGM? Because you're flying from Sweden all the way to San Francisco to attend this one meeting. What is your objective? He's like, I'm looking for minimum of one insight that I can take away. And I'm hoping to be able to ask one intelligent question that will make me and make sort of stand out as a credible LP in the minds of the GP. Can you imagine an allocator
Yeah.
that, every VC under the sun is chasing, and he is working on, making sure that he's top of mind for his GPs, and he's getting an insight, and he's asking a smart question. And the reason why he does that, and I asked him why, because it's so hard, and he was like, because it's hard to do, get access. He's like, his response surprised me as well, because his response was so macro separate. He's like, no, Asher, because I manage the money of pensioners who have no other recourse. Their entire, net worth is here. And I have a massive responsibility to take care of their pensions. So that is why I do what I do.
Yeah.
And one of the things that bothers me about a lot of LPs is that they tend to take themselves too seriously because they are allocators. And I totally get that. There is this, power that you get. But the best best LP allocators actually don't have that ego. The best LP allocators, the LPs, are actually humble like this guy. And that is what leads to avoiding the adverse selection, where the best managers, even if you're a small check, the best managers want to work with you because you are somebody who's going to make them better. And you are somebody who's going to help them bring other intelligent, smart, good LPs to build an LP cap table. And sorry, again, we digressed and went down a rabbit hole from one question to another. So hopefully we'll be able to fix this in editing.
I don't think we need to fix it in editing. I think it was a very natural progression, and I think that answer makes so much sense, because to be an investor of any kind who wants to build either like a direct practice or like a fund of funds practice, you just gotta spend so much time.
Yeah.
Because you are stewards of someone else's capital, even if it's your own capital, it's your family's capital, it's your cousin's capital, it's your grandparents' capital. It's and they worked hard to get that.
No, absolutely. Yeah. And with family offices, it's funny how, institutional family offices actually get that quite well, because the way they think about it is that this capital is not mine. I am just a steward of this, generational capital. That is it.
I agree. I think for family offices, it's deeply important, just because not only is it prior generations capital, you're also planning for the next 3 generations, the next 5 generations. Children, you probably great grandchildren, you probably might never meet, but will be deeply meaningful to that generation. I want to flip the script a little here. We talk about the LP side. I want to talk about the GP side, and we alluded to this a little bit in terms of GPs being thoughtful about exit strategy and all, but and you wrote a LinkedIn post on this recently, which is why I thought about asking this question. There's a recent report, at least at the time of this recording, by Stepstone, that 41% of funds raised since 2000 never raised a follow-on fund. Fewer than 50% of top quartile funds at year 5 stay there by year 10. And only 3.7% of bottom quartile funds make it to the top over a decade. And so out of all the funds in which you've been involved in or that you've seen, what's the most, or what are the most telling predictors of long-term success for a fund manager?
Can I go non-technical? There's a lot of things that we can talk about. It's boilerplate. But
skip the boilerplate stuff.
because I think we can all read it, right? So and this is my view, and obviously I may be wrong, but this is what I believe in. It's the pain and suffering, as Jensen would call it. Jensen Huang, founder of NVIDIA, would call it. I'm looking for the pain and suffering, or the chip on their shoulder, that is driving them to continue to be a VC, a fund manager. I'm looking for that. And if there's true pain and suffering, through chip on their shoulder, that to me is, even if they get it wrong, fund after fund after fund, it's those guys that you said that, 3.7% that are at the bottom that eventually make it at the top. I haven't checked. I'm actually curious to check, and note to self, I am going to go down that rabbit hole. As part of some research that I'm doing with the University of Michigan on emerging fund managers. So we're going to do some research there on whether that is the case, whether there's something that they have that means that they need to prove to someone, whether it's their mother or whether it is, somebody they know or an old boss or whatever, something to prove, or some pain and suffering that they've experienced that has led them to this unique insight and this desire to continue to do it, even when when their bank balance suggests that they don't need to do this anymore, but they'll continue to do it. So I think that to me, I just feels like plays such an important part in long-term success. And then the second thing is the ability to convert that pain and suffering and chip into something that's institutional, because the chip is not to say, I did it. So it's not about saying, oh, you don't think I can do this. I can't, shoot this into the hoop. And I did it. That's not what we're talking about. It's about that. It's a different type of proving. It's the proving that I can do this and do this any day of the week. And I can do this repeatedly, and I will be the best. And I will try to be the best at it, and I will be the best at it. So it's actually kind of similar to like top athletes, which is why, by the way, interesting enough, a lot of sports coaches sort of did really, really well in venture because, it's a performance game. So to me, that is really some intrinsic motivation to drives you to prove it wrong, but then also that's not enough. So I think that's my point that I was making around the sky's the limit. So the sky's the limit type thinking is like fund one is great and fund two is shit, right? But there is no limit thinking is I'm going to build a platform that is going to churn out hits after hits after hits because I'm building a long-term franchise. Now, having said that, the problem with venture is there are no rules. And this is the hardest part. And why there are no rules is because there are 7 or 8 billion people on this planet. I mean, good luck putting them into buckets, right? So like everyone is an individual. All our experiences are very unique. And so there's no right or wrong answer, and there's no formula. You can't say, well, the market is good or the market is bad. This is the best time. By the way, I'm guilty of saying that, but that is when I'm in sales mode. But the reality is, the best time, there is no such thing as a best time or the worst time, because it is not a market. And by the way, this is maybe a little bit controversial because a lot of my peers will say, well, I can't even call them peers because they're like way more established than I am. But I think what I hear from the market of LPs is like, the market's important. And of course the market is important. And I think that that's true. But I think if you truly believe in venture as a purist, then all of it is irrelevant, because at any point in time, someone will come and have this unique insight, and the timing is against them. The world is against them. They're in the wrong place at the wrong time and all of that. And yet they have this unique insight at this point in time. And they have the opportunity to invest at this point in time. And so just because the timing is wrong doesn't mean you shouldn't be backing them, because they might be right and you might be missing out on the best opportunity in your lifetime. And that is what's beautiful, is that it is a people game. So when I hear people talking about scaling venture, it's like, what the fuck are you talking about? Venture is not scalable. Venture, there are things that you can scale. There's processes that you can scale. But ultimately, you still have to rely on finding those people and finding them at the right time. And the right time could be the wrong time, but finding them when they find that opportunity, when they see that unique insight. And so to me, I've heard people say, it's not thesis driven, it's market driven. No, I disagree. I think it's both of those, but actually it's individual driven. If you can find that right person, which is why maybe it's kumbaya, but I believe that it's important to get to know the person or the persons and why they're doing it and what are they trying to solve and what is driving them. And it's the same thing that we do when we invest in founders. We're looking for intrinsic motivation because it doesn't matter. Well, I mean, obviously timing matters because maybe they're too early. Like, for example, I had this view that everything that's happening right now, I had this view that we were at that point 10 years ago. Can you imagine? 10 fucking years ago, I thought we were just at that inflection point, that point where 1 or 2 years away, we're there. It took me 10 bloody years. I got into venture 10 years ago. I had to wait 10 bloody years for this moment in time where we're at, right? You just don't know. I mean, you can model a lot of this and you can come up with sort of a guesstimation. So I guess what I'm trying to say is that all you can do is run and spin a lot of processes and be systematic and disciplined around running down those rabbit holes, getting a lot of data, creating a worldview, and then somehow, estimating in the ballpark what the, how close you are to the truth.
I want to be vigilant of time. And there's probably no better place to end on than what you just said. But I want to be vigilant of time and ask you one last question, which I'll call the quick fire round question. And these are supposed to be faster in nature, and we'll go from there. So I'll probably ask you one. And a lot of it goes down to, I know you're someone who appreciates your wine.
I'm trying to appreciate it less, by the way, but yes.
Okay, let's be honest. You and I have hung out multiple times over the last couple months.
Yeah.
You say that, and I'm going to call you out on this. In the last 5 times we've hung out, I found you sipping a libation 4 out of those 5 times.
It's terrible.
And so because I feel like this is the question for you. Mm-hmm. And I'd love to give you a couple scenarios and you let me know the beverage of choice that pairs best with each. So, sound game?
Right. Yeah.
Okay. So I'm going to give you 3 scenarios and then you just let me know the beverage of choice. So first scenario, you meet a GP at a pitch event and they want to schedule a follow-up coffee meeting with you and you know damn well they want your money. So it's a transaction. What are you sipping on?
I don't want a coffee. I will tell them I'm busy until 7 or 8, and then I'll meet them at a tapas bar, and we'll try to have Rioja, and if we can find a fusion restaurant, some gyoza.
Okay. I'll take the food answer. Okay. Second scenario. You're catching up with the GP you've invested in, but have only interacted over Zoom over the last 2 years. This is the first time you're meeting in person. What the hell are you sipping?
Yeah, I guess some rosé.
Is there a reason why?
Almost rosé because so the previous one was a Rioja, which is a Spanish grape, and that for the evening because I want to spend some time and I need to spend some time to sort of get them into the point where I'm understanding what they're about and sort of like also. Red wine will make them hopefully a little bit sleepier. With the rosé, it's like, it'll hit you faster. It's, I guess, more festive because you already have somewhat of a relationship. You've already invested in them. So this is a little bit more festive, but you also want to get the alcohol, to their bloodstream a little bit faster. But you don't want them to be, too sleepy. Because you want to, get as much of their energy. Maybe that's overthinking what I'm saying, but I'm just telling you what I'm instinctively telling you and, instinctively what I get. And then I'm kind of rationalize why I'm thinking that.
Okay, you know what? I don't need the rationalization for the last one because sometimes these are just like gut feelings. So the last situation here is a large LP on the LPAC, of which you're also on, is making a GP's life extremely difficult by trying to make the GP get to DPI by year 4. And you know you have to pull that LP aside for a private conversation.
This requires some Pinot Grigio because I'm going to be louder. As a result of this, I'll be louder and more aggressive.
Okay, I'll take it. That's all fair game. As one last thing, as you know, for every single podcast interview we do, where's the best place to find you? Because you do have a Twitter, you do have a LinkedIn, your email's quite public. You've been on a bunch of podcasts, you have a couple of websites. Where do people find you?
So actually, I kind of run my life trying to avoid, making it easy for people to find me. I'm optimizing to not be found.
Okay.
And what I tend to do...
You failed through this podcast, by the way.
Shit. but what I'm hoping for is... So what I do is I actually rely on my network. I think you and I met through my network. Majority of the people that I meet and I build relationships with, I meet through my network. But every now and then I will get a random message on LinkedIn. So I'll take a look at it, or an email. But LinkedIn's probably the best place to start, and then getting to know me, and then finding somebody that will actually... The reality is there's only one truth, which is get an intro from somebody that I know. The only thing I say is that make sure you like the person that you're getting, that you're connecting through, because I might be connected to them and I may think that they are an asshole as well. And if you think they're an asshole, then most likely I'll think you're an asshole and I won't be as motivated to meet you. Having said that, I am a little bit more open-minded today. And so now what I find is that just because I'm getting an intro through somebody that I'm not particularly a fan of, I'm still a little bit more open-minded today than I was before, because some of the most interesting people I've met have been through people that I'm maybe necessarily not on the same frequency with.
I will also caveat, if people want to do their homework, out of the Superclusters' first 2 seasons, maybe actually first 3 seasons worth of guests, there is a meaningful percentage of guests that Asher knows personally and well. That said, Asher thinks I'm an asshole, so don't get an intro through me.
You are not an asshole. You're the nicest person I know.
Well, thank you so much. This has been so fun. I always enjoy our conversations, and it's like I finally get the excuse to do the homework on a good friend of mine. So thank you so much.
Thank you.
We'll see you soon. Superclusters fans, till the next one.
So I'll tell you why. Did I ever tell you the Vinod Khosla story?
No, actually, like since we're recording anyways, like we could just include this somewhere else. But like, what is the Vinod Khosla story?
So one of the things. So this is about LPs, right? So when you think about LPs, think of themselves having capital and therefore they have power. And the reality is there is this sort of adverse selection that you run against if you have this view that capital is important, because capital is not important. What is important is what do you bring to the table? So if you go back to what we were talking about when I was talking about, like, what do you as an LP bring to the table? I had like quite an interesting sort of journey when I first started building the corporate venture platform at Etisalat. We had a fund-to-fund allocation soft circled, and it was like sizable, up to like $100 million in to look at exploring into Silicon Valley. But I was tasked to explore that to see if we could even get access to it. And I was like, that is so stupid. I mean, clearly my board members knew what I was going to experience because they were smart and much more experienced than they were at sovereign wealth funds. So they clearly knew more than I did at the time, right? So they said, well, if you think you can get into Silicon Valley venture firms, then go prove it to us and test it out. And I was like, I mean, how difficult is that going to be? $100 million checkbook, potentially. So I went. And what was interesting was what so this is 2011. September 12th or 13th, 2011, at TechCrunch Disrupt. And before that, I'd already sent a bunch of emails to Kleiner Perkins and Khosla. And what happened is Vinod Khosla was coming off the stage, and I saw him sort of exit and leave, and I didn't really know much about the how it worked, but I was like, I have been sending this guy emails. I assumed lots of different emails and variations. And by the way, don't forget, I'm like the head of M&A at this point of one of the largest telecom operators in the world, right? So, and I'm in the Middle East, and I'm from the Middle East, but I'm in the Bay Area, and I'm talking to Vinod. I'm trying to get to Vinod Khosla, and I'm not able to talk to him. And so I just say, I'm a head of M&A of Etisalat, one of the largest telecom operators in the world. I have a $100 million checkbook. We want to write LP investments, make LP investments into funds. I'd love to talk to you about this. And I'm talking very, very quickly while he doesn't slow down. He continues to walk, and then he stops. And I mean, this is a long time ago, but I know it was very noisy and whatever. But the key things, a few key things that happened. One of them, he told me, he stopped me and he was like, I'm going to stop you right there. If you want to, don't waste my time. I think he said, don't waste my fucking time, or don't waste my time. I don't know. But he said something
Okay.
don't waste my time. But if you are, earnest, or, is motivated about getting into venture, and if you're serious, I think his words were, if you're serious about getting into venture, then do the work, invest your time in building relationships, invest in your time in learning. And I kind of looked at him a little bit confused. And then he said, the last time I checked, the name on the door is Khosla. And if they're any good, they're not going to stick around very long. And I didn't understand what he meant. But a couple of years later, I started, interacting with a lot of other VC firms and fund managers, and a lot of them were emerging managers. And I started to realize their trajectories, where a lot of these people had worked at other storied firms, and then they had this desire to build their own or spin out and go into a smaller firm. And I started to sort of land into this emerging manager thesis. And what was interesting was I actually did follow some of Khosla Ventures associates and other people. And what I found is that some of these people did leave, and they went on to other firms, and then they went off to sort of co-found other firms. So Vinod was actually very helpful. And the other thing that is also very interesting is that Vinod Khosla is somebody I've only met once, but he is one of the most helpful people. I don't know what I did to deserve this, but he is one of the most helpful people that I have ever had, in addition to my friends, of course, that I know. But this is the guy that I only met once, and he's been the most helpful stranger to me. I would email Vinod Khosla. He's never responded. But clearly, he's got a chief of staff. I built relationships with some of his chief of staffs, because those are the people who read his email, and they would execute. So whatever it was, whether I wanted to meet a founder, whether I wanted to meet an LP, I wanted to get an access to, or a GP, or I wanted to get access to a conference, they would facilitate things for me. So over the years, they have him and David Whedon, his one of the partners at Khosla, have been so helpful to me, helping me to learn venture, helping me to get access to what good looks like. So now, what is the takeaway? Even though I worked for a firm that had $5 billion in the bank, cash in the bank at the time, and Vinod was well aware of that, by the way. It didn't matter, because, I mean, and look at Vinod Khosla. He is still one of the best investors on the planet. You would think he doesn't need to. He still goes to demo days. He's one of, and there's many like him, but this guy is, and that is what I'm talking about. You don't want to just invest in another good firm. You want to invest in the next Vinod Khosla.
Yeah.
Or the firm that the next Vinod Khosla is going to build. Do you know what I mean? So that's what you want. And that means you can't be lazy, arrogant, and, full of yourself. No, you need to do the work, even if you have money. And that's what I love about venture. It doesn't matter how high up the food chain you go, you're still just a human being.
Hey Superclusters fans, David from Post here. If you enjoyed today's episode, all I ask are two small things. One, there's a little red subscribe button down there if you're on YouTube, and a follow button if you're on Spotify or Apple Podcasts. If and only if you enjoyed today's episode, that's the button to click. You'll get many more presents, many more insights, and many more brilliant minds straight through the internet vines just like this one very, very soon. Two, it'd mean a lot to me if you could share it with one other friend who could gain a lot from listening to today's cosmos of insights. Also, let me know if there's anything I should have asked down in the comments, and if there's enough interest, we'll have today's guest back for an even spicier part dose. I made a promise to myself to record 100 episodes of Superclusters, so every comment, question, and review helps me make this experience more helpful and fun for you, and makes investing in venture a little less scary and a lot more friendly. And lastly, I wanted to share a quick disclaimer. The views expressed in this podcast are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of any organization that we're a part of. None of the views expressed herein constitute legal, investment, business, or tax advice. Any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor prior to making any investment decisions. And that's all from me. I'll see you on the next.